Firstly, they asked us to prepare all the necessary journal entries to correctly record all the transactions relating to the provision for refund in additional information 4 in the accounting records of Munante Limited, only for the year ended 28 Feb 2018, October, November 2018, question 1. Right. In terms of the journal entries, I am going to work a little bit more off the memo this time to save some time. We've got part A, we want journal entries for information point 4, and if you think you are going to forget, I would also go to my paper, information point 4, and just say journal entries is what I want to do over there. Right, that's part A. Your answer must comply with IAS 37 provisions, contingent liabilities, and contingent assets. The next question is to calculate the deferred tax balances in the statement of financial position of Munante for both the years ended 28 Feb 2017 and 28 Feb 2018. In terms of that, we will have our draft over here for 2017. Carrying amount, tax base, temporary difference, deferred tax, and we'll have our balance needed for 2018. Carrying amount, tax base, temporary difference, deferred tax. So every time we come across something that we need to put in there, we know exactly where to go put it. Your answer must comply with IS 12. Calculate the current tax expense in the statement of profit and loss and other comprehensive income for Munante Limited for the year ended 28 Feb 2018. And the movement in temporary differences must be calculated on the statement of financial position approach. Right. Question C. I'm going to just continue on this one big page, and that we will start with our profit before tax. In terms of our tax calculation, we'll have permanent differences. We'll have temporary differences. We'll have capital amounts, we'll have foreign income, whatever you can think of to go in there. If you want to draft it, you draft it. If you want to go point by point, that's fine too. You decide what works for you. In terms of, drafting your answer, I really do think in terms of exam technique, this might be the best way to do it. Because as you go through the information, you're not going to miss anything, as opposed to maybe reading through the information and then starting to do one part A, part B, part C, you're going to miss things. And you're going to read through information 7 times before actually getting to the answer. You guys at third year level don't have time for that. Right, discuss with reasons the appropriate accounting treatment for the information in point 5 in the annual financial statements of Munante for the year ended 2018 in terms of events after reporting date. I'm going to jump to number 5 and say we need to discuss, just so we know when we get there. E is to disclose our income tax expense note, including the tax rate recon, in the annual financial statements for the year ended in terms of IS. No comparative figures are required. All calculations need to be done to the nearest rand. This is actually really fun because we know if it balances, we know our answer is right. All right, so our tax expense note needs to balance. Let's quickly draft what that's going to look like. We'll do that, I think, on a new page. Start point E by saying these are the notes to the financial statements. This is note number 1, or you can call it note number 2, since the accounting policy is usually note number 1. But whatever note you number it as, that's irrelevant. We've got our income tax expense. Please don't say note because you've already said it's the notes to the financial statements. Major components of income tax. We've got our current, and our current is made up of SA normal, foreign, and over or under provisions. Then we've got our deferred. That is made up of a movement in temporary differences. We can have a change in tax rate. We can have a assessed loss, and we can also have a capital, but they won't ask you guys capital, so those are the three things we'll put down there for now. Then that is our tax note so far. In terms of our tax rate recon, we know that we always start with our profit before tax, and we give that to them at the tax percentage. It's probably going to be 28, but we're not sure yet. We have permanent differences, and then we have our capital and foreign income, change in tax rate over or under provision. Yes? Exempt differences, permanent differences, whatever you want, yeah. Right, let's then say we need foreign income over here. We need capital. If there is, we'll have over or under provision. We'll also have a change in tax rate. Right, and we know that this answer over here needs to balance to this answer over there. Right, so that's that. And then the last required is to disclose the change in inventory valuation method in point number 3 above in the notes to the financial statements. Right, so for information point F, they've asked us to disclose, and I'm just going to start this. They told us it's a change in inventory valuation method, so we know it's going to be an accounting policy, change in accounting policy, and we know we're going to have to put the nature, we're going to have to put the what happened, why it happened, all those kind of things. And then we're going to have 2 columns for probably what we're in 2018 and 2017. If you want, you can draft the rest. I'm not going to do that at this stage. Right, so we've got more or less what our answer needs to look like. Let's go through the information from the top. Right, Manante Limited is a wholesaler and exporter of chicken and chicken products. The financial statements of Manante for the year ended 28 Feb 2018 were presented to the Board of Directors for authorization on the 30th of April 2018. Right, so any date between those two, 30 April 18 and 28 Feb 18, would be an event after our reporting period that would either be adjusting or non-adjusting. The profit before tax in our annual financial statements for the year ended amounts to 363,650,000, and that includes the following amounts. That 3,065,650,000 I am going to need to calculate my new profit before tax, and I'm just going to go fill that in where I need that to be. Did they ask me for the profit before tax? They didn't, did they? Profit before tax, they did. In C. Calculate the correct profit before tax. C. What did I do? Sorry, I'm at the wrong question. Provision, profit before, current tax expense. So they didn't ask me for the profit before tax. There could still be adjustments though. Alright. So I'm going to start my profit before tax over here. 365,000. What I'm actually just going to do is I'm going to leave a little bit more of a space over here in case there are any adjustments. Get our permanent differences, movement in temporary differences. Right, so we want to probably get to adjusted profit before tax, and then we'll carry on. Right, so there's our profit before tax. That's what we have so far. And this includes the following amounts: an amount of 140,000 received on the 20th of Feb 2017 from CFK in respect of a sales order placed for chicken breasts, which was only delivered on request of the customer to CFK on the 1st of March 2017. Minante transfers control of chicken breasts as it is delivered. Now, one thing I do want to point out in this question is how extremely important timelines are, just to orientate yourselves and see where we are in the current state of things. If you had not drawn your timeline, you could have easily gotten your dates mixed up. We know that our year end is 30 April 2018, and the first day of our financial year would be the 1st of May. April? Oh, sorry. 28 Feb 2018. Our first day would have been the 1st of March 2018, and the last day would have been obviously 28 Feb 2017. Right, so they're telling us that we received 140,000 on the 20th of February 2017. That should be 17, sorry. So before our year started, we received 140,000. Everyone happy with that? At that date, the journal entry we would have processed would be to debit bank and credit something. We'll see now. We received that on the 20th of Feb in respect of a sales order placed for chicken breast, which was only delivered to the customer on the 1st of March 2017. So on the first day of our new financial year, these things were delivered. Do you agree with me that we are only entitled to the revenue once control transfers to the customer, which would be on the date that it is delivered? Right, so we can only recognize revenue on the 1st of March 2017. In terms of this 140, do you agree then that that is a contract liability? The income received in advance. It's not income received in advance anymore. It's a contract liability of 140,000 and 140,000. On the first day of our new financial year, what we would have done is we would have said, we debit our contract liability. We have now fulfilled our part of this contract, and we can recognize that as revenue. Talk to me. Are we happy that they included 140,000 in our profit before tax for the year? Yes, we're all happy with that. For accounting purposes, no one is complaining. However, what do we do with this 140,000? Okay, doesn't affect profit before tax. Does it affect our tax calculation? Not directly, no. But we have a contract liability or income received in advance at the end of our previous financial year. Deferred tax. Well done. Thank you. So we go to our deferred tax, and I'm working off. Where am I working off? Right, I'm working from here. We've got our contract liability of 140,000. Income received in advance, we said we have a carrying amount minus amounts that are not taxable in the future. In terms of our carrying amount, that's the 140,000. How much is taxable in the future? When will SARS tax us on money received? When we receive it, agreed? So how much will they tax in future if they've already taxed it now? Nothing. So amount not taxable in future, do you guys agree is 140,000? Right. So our tax base is equal to 0. All right. Everyone's happy. Wonderful. We're done with that first point. Dividends received from Ubuntu feeds amounting to 233. We know that dividends are not actually taxable, so that needs to come out of our tax calculation. Right. In terms of our tax calculation, just give me a second to sort ready. There we go. So we started with our profit before tax, and now we have that permanent difference or that temporary difference, that permanent difference that is the dividend income. We take it off 233,000. Do you guys want me to work off the memo, or would you prefer if I write everything out as we go? Memo is fine. Okay, 100% then. Right, so that's our deferred income over there, our dividend income. And we also know that they asked us for our whole tax rate recon. Under our tax rate recon, we've got our dividend income. We times our 233 by 28%, and we include only 65,240. That is negative. We want to not tax that. Is everyone happy? Great. So we're done with this point. Profit on the sale of farmland situated in Mafikeng amounted to 155,000. The land was originally purchased with the intent of expanding Manante's operations. The land was purchased on the 1st of March 2015 at a cost of 1.2 million and sold on the 28th of Feb 2018. The land was accounted for according to the cost model. Right, in terms of our land, we have a profit. Is this a capital profit? Yes. Do you guys agree that our selling price was higher than our cost? Land is a non-depreciable asset, so we have a capital profit. In terms of a capital profit, that will be in our tax calc. We will have to exclude that capital profit because we are not going to actually be taxed on the capital profit of 155. It's included in our profit before tax, so we take it out there. However, what we will be taxed on is the capital gains rate of that. So at 80%, that's what we will be taxed on, and we add that capital gain of 155 times 80%, and that must be added. Okay, just please fix this negative. It should be added over there. Right, not taken off. Sorry? The 124,000. Point C, yes. Are you sure? Right, are you guys comfortable? Any questions? Right, this will also affect our tax rate recon. So going over to that place, we know that we have capital gains. We know that we're taking it out at the normal rate, so minus 155,000 times 28%, because this is my tax rate recon. That's what we're taking out. What we are actually being taxed on is 155,000 at 80%, because this is a capital profit. So we're adding that back. Foreign. This one. Oh, I don't know why it says that. It shouldn't say that. It should say capital. Right, so it's the capital gains rate. All right, profit. There we go. That's done. You guys are all happy with this? Right. Foreign income of 33,000 was received from Mauritius. This is not taxable in the Republic of South Africa in terms of a double taxation agreement, and we paid foreign tax of 3,300. Again, this will affect our tax calculation and our tax rate recon. Right, so let's have a look then at the solution over here. Our calculation, we will need to take out that foreign income of 33,000. So we take out 33,000. It was included in our profit before tax. We now want to not tax it, so we exclude it at 33,000 Rand. In terms of our tax rate recon, when we have a look then at our foreign income, we take out the 33,000 at 28%, and we add whatever foreign tax we are going to pay. And they told us that we will pay 3,300. So we add back 3,300, and we are left with that difference. Everyone's still happy? Awesome. Right, so we're done with that, and information point 1 is done. In terms of information point 2, they told us that this relates to our non-current assets, and they gave us an extract from the asset register of Menante, which you can assume to be correct. Right, I know all of you have auditing, and what you want to do is you always want to just test and make sure what they gave you is right. If they tell you it's correct, just go with it. If it's correct, if it's not correct, they told you it's correct, that's what you go with. Right. From the 1st of March 2015, all the assets were acquired and available for use as intended by management. On this date, all the assets were brought into use. On the 1st of July 2017, Menante decided to outsource its distribution division and sold all of its delivery trucks for $480,000. No other assets were acquired or sold since the 1st of March 2015, except for those mentioned above. The depreciation and profit on sale of the above-mentioned assets have already been correctly included in the accounting records at year ended 2018. Right, so it doesn't affect our profit before tax. However, these will affect our movement in temporary differences, and we need to put that in our calculation to calculate our deferred tax. Right, firstly, I'm going to start with what did they give me that I can use off the bat. They gave me the balances, the carrying amounts, and the tax bases for all of these vehicles for the 2017 financial year, and I'm going to put them into my calculation for 2017, just like that. Delivery trucks, 460,800 carrying amount, 240,000 tax base. Industrial fridge, 850,500 carrying amount, tax base 700,000. All of that given to me, nothing needed to be calculated. Right, in terms of the calculation then for our 2018 balances, we want a carrying amount and we want a tax base. We know that both these, what did we sell? We sold all our trucks. So let's first look at the industrial fridges. We had a carrying amount of 850,500 or 800, 500. We had a tax base of 700,000. Right. They told us that the depreciation had already been correctly accounted for. Let's see if they gave us that. They didn't give us anything. They are depreciated on the reducing balance method. Nothing, in terms of industrial fridges, nothing has been bought, nothing has been sold, so we're only working with what we had at the beginning, minus depreciation for carrying amount purposes, minus wear and tear for tax purposes. Everyone's happy with that? Right. In terms of our depreciation, we work on the reducing balance method. They are depreciated at 10% per annum. So do you guys agree that 850,000 at 10% will give me 85050? Everyone happy with that depreciation? Right, then we'll get our carrying amount over there. In terms of wear and tear, they told us that these assets are straight line over 6 years. So that'll be, my calculation there would be to say 1050, which is the cost, divided by 6. I think that's 175 or 176,000. And that is the wear and tear for the current year. I get to my tax base, and easy enough, I can just go and fill those two in for my industrial fridges. These are the balances. If you look at my calculations over there, we've got carrying amount minus depreciation or wear at that amount. And for SARS, I didn't actually put the calculations here. Let me just say that is 71050 times divided by 6 years. Sorry. Divided by 6, and this one is 850 times 10%. Right, so everyone happy with that then? Right, so we've got our industrial fridges. In terms of the carrying amount of these delivery vehicles, they said that they outsourced their delivery function from the 1st of July 2017, and where we drew our timeline is that all the way to the front over here, 1st of July 2017, that is in the middle of our financial year, we sold all our delivery trucks and vehicles. So would you agree with me that at the end of the year, we would have nothing left and our tax base for our vehicles would be 0? Right, everyone's happy with that. The other thing I just want to make sure of is, did they make a capital profit when they sold these vehicles? They said that they sold the vehicles for 480,000. We only have a capital profit if my selling price exceeds my cost. My cost is 720. Do I have a capital profit? No, nothing else for me to do here. They said that the depreciation has been correctly accounted for, so I'm done there. Is everyone happy? All right. Inventory. After the review of the draft financial statements of Minante, the financial director decided to change the current inventory valuation method from the weighted average to the first in, first out, to ensure that a more appropriate estimate of the value of inventory is ascertained. This change in accounting policy has already been correctly recorded in the accounting records of Minante. Right, so it's already been correctly recorded. I don't have to adjust my profit before tax. Happy? And they've given me the summary over here. We are going from the weighted average to the first in, first out method. From weighted average to first in, first out. So moving there. And they gave us the balances for 2018, 2017, and 2016. There was no first in, first out method. And they give me a reason here. The value of inventory for the year ended 2016 could not be determined due to lack of historical data. Now, that is something important to mention in your note. Firstly, we'll say that, the inventory valuation method changed. And if I'm not mistaken, we actually have to disclose this. Yes. Right, so the inventory valuation method has changed from first in, first out to, from weighted average to first in, first out. This was the financial effect. We know that change in accounting policy is always retrospectively adjusted, but because we don't have the balance for 2016, we need to have an additional disclosure in our note saying that we couldn't disclose this retrospectively due to the fire that destroyed the data. Right, and that'll be worth another extra mark over there. All right, guys, so let's quickly have a look then. Yes. Yes. If nothing. Okay. Yes. Yes. Is it? Where? Oh, what she's saying is there's the writing, yes. Right, so you guys there needs to be writing. I do apologize that it's not in there. I will correct this, post the right one online. You have to put the nature. Let me quickly just jot down the few things that will be in here. You will say that there was a change in accounting policy during the current year. You will say that you went from we went from weighted average to the first in, first out method. We would then say that this was because, what did they tell us? Why did we do this? They said that we changed so that we can have a more appropriate estimate of the value of inventory for a more appropriate value of inventory. So that's what they said. And then we have to say that we could not disclose 2016 values as they were destroyed in a fire. Right, so that'll basically be your little paragraph of writing. Okay, you guys quite happy with that? I'll fill it into the memo, post the right one online then. All right, getting back to this. They said that SARS will not reopen previous years. What does that mean? For previous years, we will have deferred tax. Furthermore, they said that SARS will not accept the new inventory valuation method. A few of you guys asked me about this. Here's the perfect example. Right, so SARS will not accept the new inventory valuation method. That means that we will have deferred tax forevermore. All right, going forward. Okay, so if we quickly look at our journal entries, the calculation was done over here. So in 2017, we went from weighted average to first in, first out. Do you guys agree that we had an increase in our inventory value of 50,000 Rand? Our inventory increased, so we want to debit inventory with 50,000 and credit cost of sales with 50,000. That will have a deferred tax effect, debit income tax expense, credit deferred tax. We are debiting our income tax expense because we are showing the 2017 year. There's no 2016 year. If there were, we would have that retained earnings balance, right? Okay, and that is 14,500. Can I just quickly say why I did this at 29%? That is because the tax rate was 29 in 2017 and 28% in 2018. All right. So that is at 29% there. In 2018, we had an increase in inventory again. We went from 488,732 to 513,000. So we need to debit our inventory again and credit our cost of sales. The amount there is 24,768. In terms of our deferred tax, we then have a deferred tax movement. We debit our income tax expense, credit our deferred tax with 6935, and that will be our 24,768 times 28% because our tax rate changed. Right. In the current financial year, we're saying that whatever happened last year, that inventory that was on hand has been sold during our current year, so we need to reverse that journal entry. Debit cost of sales, credit inventory with 50,000. Similarly, with our deferred tax expense, debit deferred tax, credit our income tax expense with that full journal. Now, the last thing that happens is we had a change in tax rate, and this 14,500 from last year would now be less. So what I did is I said 14,000 times 1 over 29, and I accounted for that difference. We debited our deferred tax, credited our income tax expense. Are you guys all happy with that? All right. So that is our journals. In terms of the note disclosure, what I do is I usually indicate what effect this has on my profit or loss. So if it's an increase in cost of sales, it'll decrease my profit and loss, and that's why I will generally put my cost of sales in brackets then, right? It's not incorrect to do it other way around. You find what works best for you. This is just what works best for me. In 2017, let's start with the inventory side. We had an increase in inventory of 50,000, and we had an increase in our deferred tax liability of 14,500. This increase in the deferred tax liability has a negative effect on my equity, and that's why I have that in brackets. So the total effect on my equity is 35,000 Rand, 35,500. Everyone's happy with that. 2018, we had an increase in inventory again of 24,476, and our deferred tax liability, I will get to that calculation right now. Let's just quickly jump back and do our cost of sales side of things. For 2017, if we look at our journals, there there was only that one journal entry where we debited cost of sales. So all we had for cost of sales was a decrease in cost of sales of 50,000, which increases my profit before tax, and the tax effect of 14,000. Everyone still happy? All right. If we look at our journals again, for 2018, we have a credit to cost of sales of 24,000. We have a debit to cost of sales of 50,000. Does everyone agree that my debit is larger than my credit? So we will have a general increase in cost of sales, which will lead to a decrease in my profit. And that is why I have the 25,232 as a credit. You guys know where I got that. Everyone's happy. Right. In terms of my income tax expense, I had a debit and I had a credit. The credit was larger than the debit, so I had a general credit to income tax expense, and that would be a decrease to my income tax expense. What did I say? General credit. Yes, that will decrease my income tax expense. I think these two are just swapped around, and then that is 7062. We end up with 18,000. Right, in terms of our rule, we said we go from 35,500 plus the 18,000, or minus in this case, should get us to our 17,300. I'm quickly going to show you guys that. 35,500 minus 18,167. That gets us to our 17,333. You guys will see that this does not necessarily agree with my journal entry. What I did there is I added the 500 Rand from that tax rate change. Right, so it's the 24,700 times the 28% plus the 500 Rand from my tax rate change to get it to balance. Are you guys happy? Questions? Fine. Right. In terms of inventory, we have done our disclosure. That's what they asked for. Did they tell us that this is all already recorded? They did say that, didn't they? Everything's already recorded, doesn't affect my tax calc. However, it does affect my deferred tax calculation. And because they did not reopen last year and they will not accept this year, we will have inventory in both those calculations. Right, so let's have a look at our deferred tax then. For 2016, right, for 2016, our inventory balance was 425,000. That was the carrying amount, and our tax base was 375,000. That was our tax base. In terms of 2018, our carrying amount was 513,500. Tax base 488,732. There's our inventory over there. Right, so we've done that inventory calculation. Is everyone comfortable? I have not gone through whether it's an asset or liability. I'll do that at the end with you guys. I'm just putting in what I need now. All right. Journal entries. We need to disclose these journal entries for point number 4. Menante introduced a policy in the previous financial year to refund customers for chicken fillets within 2 months from the date of sale if the customer had a valid complaint regarding the quality of the chicken. This refund policy is specifically included in the supplier's terms between Menante and their customers. A provision for refund amounting to 85,000 was made in the annual financial statements of Menante for the year ended 28 Feb 2017, and in 2016 that was 0. Right, as we read, I'm going to start just doing a little calculation for that. We need to do the journal entries. Right. So we've got a provision, we've got an expense, we've got bank. Those are the 3 accounts that are affected by our provision. A provision for refund amounting to 85,000 was made in the annual financial statements for the year ended 2017. Right, so in terms of our provision, we started with a closing balance in 2016 of 0. In 2017, we had a closing balance of, actually guys, sorry, what I'm going to do is I'm going to do the note format over here, and then we will do the journal entries differently. Right, so if we have 2018 and 2017, we've got an opening balance, raised, utilized, and reversed, and then we have a closing balance. All right. Our opening balance for 2017, everyone's happy, is 0, and closing balance was that 85,000. Everyone happy with that? Awesome. Based on past sales history during the current year, 30,000 was paid to dissatisfied customers for chicken fillets, of which 9,700 related to sales of chicken fillets for the year ended 2017. I'm going to draw my timeline again. We are here in 2018. We had 2017 and we had 2016. So they said that during the 2017 year, 30,000 was paid out to customers. Is everyone happy? In terms of that, my journal entry would be to debit something and to credit my bank because I paid 30,000. Everyone happy with that? Right. 9,700 related to the provision that existed in 2017, which was 85,000. Right. So of this 30,000, within those first 2 months, 9,700 related to that 85. Is everyone happy with that? Right. Do you guys agree that that is my provision utilized in the current year? 9,700. Everyone happy? Of this 85,000 that we had over here, how much is still left at the end of the year 2018? How long is this provision for? They said 2 months. So of the 85, how much is left at year end for 2018 when I get here? Do you guys agree? 0? It was either paid out or it was reversed. Right. So whatever was reversed, that should amount to 85. Not going to do the calculation now. Right. This 9,700, you guys all agree that was a reversal of my previous provision. All right. And to reverse that provision, can we debit it? Are you guys happy with that? Have I lost you? Who have I lost? Okay, where have I lost you? Should I start over? All right. In terms of my provision, maybe I should draw these T accounts. Are the T accounts better? Okay. Right, let's do the T accounts. I had a provision. I'm going to say start in 2017. Let's start in 20. Let's just have a new page. Right. Provision. In 2016, we had a provision of 0, and in 2017, we ended with a provision of 85,000. Okay, happy with that? In terms of this 85,000 provision, after year end, so in our current financial year, we paid out 30,000. Of that 30,000, 9,700 related to this provision. You guys are happy with that? So in terms of that, we need to reverse that provision. Let's just work with the 9,700. Let's say this is our bank, and this is our expense. Right. Out of the bank, we paid 9,700, and that reversed our provision. Right. Is everyone happy with that? So we would have debited our provision, credited our bank with 9,700. Now, we still have 30, that whole 30,000 we still need to account for. We've already accounted for 9,700. So the rest of that provision is at 21,300. Let's go with that, 20,300. 20,300 also came out of my bank. Everyone's happy with that? Right, so we credited my bank with 20,300. And for that, we couldn't reverse this provision because there was no provision raised. So we had to go to our expense account. Expense 20,300. All right, so you guys happy with that? Right, so that's up to where we got. 9,000 related to those sales. The financial director estimated that 78,000 will be refunded to dissatisfied customers in the first 2 months of the next financial year. Right. In the first 2 months of the next financial year, so we're walking on here, and we're saying that will be up until 28 Feb, 28 March, April. So in these 2 months, he expects that 78,000 will be refunded to my customers. So I'm going to erase a provision of that 78,000. Back to my journal entries. My provision must now increase with 78,000. And I will debit my expense, 78,000. Everyone's still happy? All right. Then they said that is chicken fillet sold during the past 2 years, first 2 months. All transactions relating to payments and provisions for refunds for the current year have not yet been recorded. Right, that's why they asked us for the journal entries. That's why we're recording them in our financials. All right, so in terms of the information we have, I'm going to fill it in to our note over here. We said that this year we raised a provision in 2018 of 78,000. And you guys agreed with me that this full 85 should be 0 by the end of the year. So whatever is still in here, okay, my opening balance, sorry, was 85. We raised 78, and we should reverse the balance over there so that we get back to 78,000, whatever this number is. Happy? Yes. No, the 9,700 is what we utilized. That's what we actually used of that provision, and the rest is what we reversed. Okay. Now, in terms of 2017, do you guys agree that this 85,000, nothing came from 2017, so everything should have been raised in the 2017 year? They didn't tell us anything about reversed or utilized for that year. So let's just leave it at that and quickly have a look at what our disclosure looks like. That disclosure, where's that? They don't want one. Oh, okay. They just wanted the journals. All right then. Yes. All right, so in terms of the journals, putting them out like this, are you guys happy that we credited the bank with that 30,000? You guys are happy that 9,700 went to the provision account and that the rest went to a refund expense account? Furthermore, you guys are happy that we debited our provision with 75,300 and we credited that refund expense. That would have been this amount over here. What was it? 75,300. That's what we reversed. Happy? Okay. Then you guys would also be happy that we debited a refund expense of 78,000 and credited that provision for refund with 78,000 to arrive at that 78. Okay, is everyone comfortable with that? Okay, we've already mentioned that this has a deferred tax effect. Does it have any other effect? Do we need to consider it anywhere else? Profit before tax, perfect. They told us that this has not been accounted for in our accounting records yet, and here we touched our P&L 3 times. All right, so just jumping to that question C, our refund expense needed to be an adjustment to our profit. So we had that 20,300, which was a debit, plus the 78,000 that was a debit, minus the 75,300 that was a credit, and that gave us an expense of 23,000 that needed to be taken off our profit before tax. Is everyone happy with that? Right, and then we have our deferred tax. So for the provision, we said in 2017 we have 85,000. The tax base of a liability is the carrying amount minus future tax deductions. We will only get a deduction once we pay this, so the deductions in the future is 85, carrying amount is 85, tax base 0. Everyone happy? Same principle for 2018, 0 tax base, our carrying amount is 78,000. All right, everyone comfortable? So we're done with information point number 4. Number 5, and they wanted us to discuss this one. Due to the outbreak of listeriosis disease in South Africa, the Minister of Health in Botswana announced on the 8th of March that they are banning the import of chicken from South Africa. And that we as a company, basically we export to Botswana. This will affect our sales in the next financial year because we don't have those exports anymore. All right. Our year end is 28 Feb 2018. This happened on the 8th of March, which is after our reporting date, but before the date that the financial statements were authorized. In terms of the ban, at year end, were we still allowed to export to Botswana? Yes. So is this an adjusting or a non-adjusting event? Non-adjusting, because it happened after year end. The only thing we need to do over here is disclose. Now, they didn't ask us to disclose, they only asked us to discuss. So where I want you to start, have a look at your memo, is just mention to them what is an event after reporting period, those events favorable and unfavorable that happened after the reporting period but before the date of authorization of our financials. This can be either adjusting or non-adjusting. Because this event did not exist at reporting date, it will be a non-adjusting event, and the only thing we would need to do is disclose that. Right. Have a look at the model answer there. That is basically the gist of it. Right, in terms of our taxation, we have 29 in 2017, 28 in 2018. They don't tell us anything else that is significant or that will change our answer. So I'm going to go through the solution we have and just sum it up and complete it as we've gone through all the information now. Right, you guys are happy with point A. We've done everything we needed to do there. In terms of point B, we've only filled in the carrying amount and the tax base. In terms of our industrial fridge, do you guys agree that our carrying amount is larger than our tax base, and that will lead us to a taxable temporary difference, which is a liability? Our delivery truck, same thing, carrying amount of our asset is larger than the tax base. Taxable temporary difference, again, it's a liability. Our provision for refund, we have a liability where our carrying amount is larger than our tax base. That means in future, we will get those deductions. You guys are happy with that? And that is why it's a deductible temporary difference. Leads to an asset. Same with our contract liability. In future, we will get those deductions, so it is an asset. Right, you guys are comfortable with whether it's an asset or a liability? All right. You guys are comfortable with the calculations. 2017 will be at 29%. 2018 will be at 28%. All right, everyone's still happy. Wonderful. Calculations, we've done those. Delivery vehicles, we've done that. Now our profit before tax, we have talked about that. We've put in all these things. The only thing we are missing is this movement in temporary difference. And the calculation for that has been done over here. Just maybe you guys keep your deferred tax calculations open. I'm not going to go back to those. We started with the opening balance, and it was a liability of 56,927 times 1 over 29, and that brings it to 28%. We are moving in a asset direction, reducing our liability. Think of it like this. This is what we owe SARS when it was at 29%. Because our tax rate reduced to 28%, we now owe them less. Right, so that's why we are reducing our liability. At the end of the year, we had a liability of 52,421, and that means that our movement in temporary difference was again in a positive direction, 2,543. Right, so for our tax calculation, that 2543 divided by, we want to gross it up to 100%. It is at 28% currently. So either times 100 over 28 or just divided by 28 gives you 9082. Is everyone comfortable? Right, in terms of whether that should be positive or negative, I'm going to quickly jump back here. We said that we had a liability that moved to a smaller liability, so we moved in a asset direction or in a deductible direction. Everyone's happy with that? That deduction will only be available in future. So in the current year, it is taxable, and that is why we added back there. Everyone happy? Right. That is then point C. We're done with that. We get to our, again, should be added back. Taxable income of this amount, and that gives you your current tax expense when you add it, times it by 28%. Right. The next one, we've done point D. We discussed that. Our tax note, our current tax expense, SA normal tax, that comes from point C. That's what we just calculated over here. It mustn't be negative, yeah. It must be positive. I'm not sure if this amount is then correct or not. Is it correct as a positive? Okay, so that was just a typo. Oh, okay. So that was just a typo. The amount is calculated correctly. This 934943 goes then to our tax note, 943. We had our foreign tax. We had already put that in. That increases our current tax expense. In terms of our deferred tax, we said that we had that movement, 2,943, and we had a change in tax rate, 1,963. And that gives us the grand total over here of 933,737. That is the income tax expense that will go to your profit and loss statement. I'm just going to write that there. Goes to profit or loss. Now, in terms of our tax rate recon, we started with this profit before tax. This was the adjusted one. At 28%, it'll give us that amount. We took off the dividend income. We dealt with our capital gains. We dealt with our foreign income. And now we just put in that change in tax rate. And that again leaves us with 933,773. All right. Is everyone comfortable with the tax rate recon, the tax note, all those things? We've disclosed this point. I've told you guys what still needs to be in there. Are there any questions about this question? None. All right.